When people talk about growth stocks, they usually make the same mistake. They chase excitement instead of asymmetry. They fall in love with stories instead of mismatches, and they confuse what is popular with what is attractive. I have never thought that was the right way to invest. The best growth opportunities usually do not come when everyone is already celebrating them. They come when the business is still growing. The runway is still open, and the market has become uncertain enough that the valuation no longer fully reflects what the company can become over the next 5 or 10 years. That is the real setup, not growth for growth's sake, growth plus a valuation mismatch. The source document you gave me understood that better than most people realize, under all the noise, under all the emotion, under all the ticker symbol enthusiasm. The real argument was not, here are 4 hot names. The real argument was much better than that. It was this: there are still companies in the market with unusually strong growth paths, but because of short-term fear, misunderstanding, or temporary ugliness in the numbers, you can still buy them before the market fully reconnects price to possibility. That is the idea worth protecting. And the 4 companies in the source fit that pattern for different reasons. SoFi, ServiceNow, e.l.f. Beauty, Celsius, 4 very different businesses, 4 very different sectors, but all sitting inside the same broader setup. The growth is not dead. The market simply got nervous first. Now let me start with the first one, because I think this is the easiest story for ordinary investors to understand once they strip away the ticker. SoFi is not really a lending story anymore. It is becoming a financial platform story that is a much bigger thing, and if the market continues to value it only as a lender, the market is going to stay behind the actual business. That is the opportunity. The source document leaned very heavily into that, and I think the instinct was exactly right. SoFi's first quarter 2026 results were strong enough that the core business argument no longer depends on hope. The company reported record net revenue of $1.1 billion, net income of $167 million, 14.7 million members, and 22.2 million products. That is not a fake growth story. That is a real one. Those numbers matter because they tell you 3 things at once. First, customer acquisition is working. Second, product expansion is working. Third, profitability is no longer a vague someday idea. When a financial company starts combining those 3 things at the same time, the discussion changes. Now, why do I think the market still struggles with SoFi? Because it is trapped between categories, and businesses trapped between categories are often where the biggest re-ratings come from. The market likes simple labels: bank, fintech, lender, broker, payments company, software company, insurance company. It likes things that fit neatly into a box. SoFi does not fit neatly, and that is what makes it powerful. It can attract deposits, sell loans, retain some loans, distribute other loans, sell products, deepen customer relationships, and expand monetization across the same user base without needing to look like an old-fashioned branch bank in order to do it. That is a very different operating model, and it is one reason I think people still underappreciate what Anthony Noto has actually built. Traditional banks had to become large the old way: physical branch networks, heavy staffing, legacy systems, deep operating cost structures, slow product evolution. SoFi is trying to become large the modern way: digital interface, lower physical friction, unified app experience, data-driven sell brand that skews younger, that does not guarantee it wins, but it does mean if it wins, it can become something more profitable and more scalable than the old template many people still use to analyze it. That is why I think the source was right to put it first. This is not about one good quarter. It is about a company moving toward financial institution scale without inheriting the full old world burden of becoming a financial institution the traditional way. And when I look at the size difference between where SoFi is and where the established giants still are, I do not see a company that is already mature. I see a company that is still early in the part that matters, not early in age, early in penetration. That is a very different thing. The market cap tells you that too. SoFi's equity value is still tiny compared with the established financial giants it is ultimately trying to challenge. On May 7, 2026, the stock was trading around $16.3 with a market cap just above $21 billion. That is not 10 million, but in the context of what large financial platforms can become, it is still small enough that the upside remains relevant if execution stays strong. Now, I am not blind to the risks here. This is still finance. Credit can turn, funding can tighten, recession can expose weak underwriting, customer growth can slow, brand advantage can fade if execution weakens. And because this is still a financial business, it will eventually have to survive a real ugly cycle without losing trust. That matters. But those are exactly the kinds of risks that sit next to every genuine long-term compounder in the financial space. The question is whether the company has enough growth, enough product depth, enough customer love, and enough operating leverage to emerge from those cycles stronger. Right now, I think the answer is yes. That is why the mismatch remains interesting. Now let us go to ServiceNow, because this one is a very different kind of misunderstanding. With SoFi, the market still seems confused about category. With ServiceNow, the market seems confused about what AI means for the business, and I think that confusion has created the weakness. The source document was right to focus on the stock's collapse first, because price is what gets people's attention. But the deeper question is not why is the stock down. The deeper question is, what does the market think is broken here that the business itself is not actually confirming? That is the real issue. ServiceNow, as first quarter of 2026, was not a weak quarter. It reported $3.77 billion of revenue, up 22% year over year, with subscription revenue of $3.671 billion, also up 22%, and then it raised full-year subscription guidance to roughly $15.74 billion to $15.78 billion. Those are not numbers from a company whose growth story has fallen apart. So why has the stock been punished? Because the market does not know how to price this awkward in-between period. That is the key. A lot of investors are nervous that AI changes the enterprise software stack in ways that could hurt legacy workflow platforms at the same time. ServiceNow is spending, acquiring, and integrating aggressively enough that margins are under temporary pressure. That creates the exact kind of setup where a stock can become dramatically cheaper even while the business itself keeps executing at a high level. And those are the situations I care about most. Not because they are comfortable, because they are where the mismatch can become unusually large. ServiceNow is still one of the cleanest software business models in the market. Recurring revenue, deep integration into enterprise workflows, high switching costs, mission-critical positioning inside large organizations. Once a company has ServiceNow deeply embedded across its systems, replacing it is not like swapping out a consumer app. It is expensive, disruptive, organizationally annoying, and often politically difficult inside the company itself. That is exactly what you want in a software business. You want a product that is hard to rip out once it becomes central to how work gets done. Now layer AI on top of that. This is where a lot of people, in my view, are thinking too superficially. They hear AI and assume existing workflow and enterprise platforms should be threatened. Maybe some will be, but platforms that sit closest to enterprise process, enterprise data, orchestration, ticketing, approvals, workflow, support, and system coordination can also become major beneficiaries if AI becomes more deeply embedded into how businesses operate. That is how I see ServiceNow. Not as the dinosaur AI kills, but as one of the control layers AI may actually need. That is why Bill McDermott keeps leaning into the AI control tower language. And whether or not you like the branding, the strategic direction is clear. The company wants to be where enterprise process and AI automation meet. That is a very valuable place to sit if they pull it off. And the recent numbers suggest they are pulling off more of it than the market currently gives them credit for. ServiceNow said its Now Assist customers spending over $1 million in ACV grew more than 130% year over year. And outside reporting says AI-related ACV is already moving faster than management previously expected. That matters because it says AI is not simply a threat hanging above the business. It is becoming a growth engine inside the business. Again, not risk-free, not simple, but very different from the market's laissez-faire narrative. Now, I do not want to dismiss the concerns. The company's recent acquisitions, especially Armis, are putting pressure on margins. Integration risk is real. Some large Middle East deals were delayed, and the stock got hit hard enough that investors clearly wanted a cleaner story. Fine, markets are allowed to be uncomfortable. What I care about is whether the discomfort is larger than the actual damage. And right now I think it is, because if the company can keep growing around 20% while AI attach rates deepen and margins normalize later rather than now, then the stock weakness starts looking much less like an omen and much more like a gift. That is how I think about it. And the stock price tells you why the setup is still interesting. As of May 7, 2026, ServiceNow was trading around $89.05 with a market cap near $92.6 billion after a brutal derating. That is still a large company, but it is a much more attractive entry point than investors were being offered when the market priced it like AI uncertainty could not touch it. Now let us move to e.l.f. Beauty, because this is where people who only invest in tech themes miss one of the most beautiful business models in the market. e.l.f. is not exciting in the same way as quantum computing or AI platforms. It is exciting in a much better way. It is exciting because it is a consumer compounding machine that still has more runway than the market seems willing to grant it. That is the story. And the source document was right to emphasize that this is not only an e.l.f. brand story anymore, it is becoming a multi-brand platform story that matters. Very few consumer companies get to be both affordable and loved. That combination is rare. Usually you get affordable and forgettable, or loved and expensive. What e.l.f. has built is different. It found a way to create highly accessible price points, strong product quality, fast trend response, digital native cultural relevance, and retail execution that works at mass scale. That is very hard to replicate. That is why the core brand keeps outperforming what many people thought was possible. Now add Rode. This is where the source got especially excited. And I understand why. Rode is not just another acquired brand sitting quietly inside the portfolio. It is a velocity asset. It is one of the hottest beauty brands in the market. And importantly, it is still in the stage where retail expansion and category expansion can drive outsized growth if the integration is handled correctly. e.l.f. Beauty announced the definitive agreement to acquire Rode in May 2025 for about $1 billion. And by April 2026, it was already publicizing Rode's continued expansion into Sephora channels, reinforcing the sense that this is not a sleepy tuck-in deal that matters. Because the best acquisitions do not just add revenue, they accelerate the platform, they widen the customer base, they create new monetization paths, they deepen cultural relevance. Rode can do all of that if execution stays sharp. And because e.l.f. already knows how to scale brands inside mass retail and digital channels, this is one of the more interesting combinations in the sector. The market, of course, sees the temporary ugliness first. It sees integration risk, it sees shifting profitability, it sees the need to prove the acquisition works, and it discounts the stock before the evidence is fully visible. That is exactly the kind of setup I like. Now, the existing business itself is not weak. e.l.f. fiscal third quarter 2026 results showed net sales of $1.314 billion, and management raised full-year fiscal 2026 outlook to $1.600 billion to $1.612 billion in net sales, which implies expected growth of roughly 22 to 23% for the year. That is not some tired consumer story. That is a business still growing at a very serious clip. And when you think about what makes beauty businesses truly great, this one keeps checking the right boxes. The products are consumable. The purchase habit repeats. Brand loyalty is real. The gross margin profile is attractive. The category is emotionally engaging. And if the company keeps allocating capital intelligently, it can build something that looks less like one product cycle and more like an enduring consumer ecosystem. That is what I think the market is still underpricing. Now let me say something even more directly. I do not think the market knows what to do with a beauty company that still has this kind of top-line momentum, this kind of brand relevance, and this kind of optionality through acquisitions, while the multiple has already compressed as if the best years are behind it. That mismatch is why the stock interests me. At around $61.43 on May 7, 2026, e.l.f. Beauty's market cap was only about $3.7 billion. For a company with this kind of brand power, this kind of growth, and this kind of strategic optionality that is still small enough to matter a lot if management keeps executing. Now, of course, consumer stocks are never without risk. Taste changes. Competition is relentless. A trendy brand can cool off. Retailers can change shelf dynamics. Integration can go wrong. The consumer can weaken. But the reason I like e.l.f. here is not because it is riskless. It is because the combination of core brand strength plus Rode upside plus still compressed expectations creates a payoff profile that is very hard to find in a consumer name of this quality. That is the mismatch. Now let us go to Celsius, because this one sits somewhere between a beverage story and a platform story. And that is what makes it interesting. A lot of people still think of Celsius as the energy drink stock. That is outdated. This is becoming a broader beverage platform with international runway, a deeper distribution spine, and multiple brands that can ride the same system. And if you understand the history of beverage wealth creation, you know how powerful that can become. Coca-Cola, Pepsi, Monster. The best beverage stories are not really about drinks. They are about distribution, habit, brand repetition, shelf space, global scale, and once a beverage company locks into a powerful distribution partner while keeping its brand heat, the upside can become enormous over time. That is why the source document was right to frame Celsius as still early. It already had a huge run, fine. That does not mean the story is mature. In many ways, it is just getting organized. Celsius 2025 results showed what that organization can look like. Revenue for the year reached about $2.515 billion. That's 8.15% year over year, driven heavily by the Alani Nu acquisition, while the core Celsius brand still grew to $1.458 billion. Fourth quarter 2025 sales were about $722 million, with Alani Nu contributing around $370 million and Rockstar about $45 million. Those are not small numbers. And what they tell you is that this business has already moved from a single brand story to a multi-brand scaled beverage platform story that is a very different thing. Then there is Pepsi. This is where the long-term opportunity gets much more interesting. Celsius S 2026 proxy materials make clear PepsiCo now leads distribution for Celsius. Alani Nu and Rockstar in the US and Canada, that matters far more than many people realize, because beverage fortunes are made and broken in distribution. Great product with weak distribution is just a nice idea. Great product with powerful distribution becomes something much more dangerous. That is the setup here. You have a company whose domestic opportunity is still not fully saturated. You have acquired brands that can scale harder inside the new system. And then you have the real long-term prize, which is international. That is the part I think the source was most right about. In the next decade, international is where this can become much bigger than the market currently imagines. Because while Celsius and its associated brands are now highly visible in the US, the global white space is still massive. And beverage models with repeat consumption and strong distribution leverage tend to surprise people on the upside when they cross borders successfully. Now let us say something about valuation. This is where the stock gets interesting again. The market punished Celsius hard as growth normalized and integration questions rose. That is exactly what markets do. They punish a growth stock the moment it stops feeling easy. But when I look at Celsius, I do not see a dead growth story. I see a company whose next phase is simply more operational and less fantasy-driven than its first one. And that is healthy. At around $32.80 on May 7, 2026, Celsius had a market cap of roughly $8.46 billion. That is not 10 million, but for a beverage platform with this brand set, this distribution support, and this much international white space, it is still small enough that a long runway can matter enormously. Now, does that mean it goes straight up? Of course not. Beverage markets are vicious. Competition never stops. Shelf dynamics matter, execution matters, cultural relevance matters, but I have seen enough great beverage businesses over time to know that when a company has a real repeat consumption product, a real brand, and a real distribution machine behind it, the long-term wealth creation can be extraordinary. That is why I think the story is still early. Now let us pull all four together, because that is where the real insight lives. These are not four random growth names. They are four examples of the same kind of mismatch showing up in four different sectors. SoFi is a digital financial platform still being valued too narrowly for what it can become. ServiceNow is a mission, critical enterprise platform being marked down because the market cannot get comfortable with the AI transition and temporary margin pressure. e.l.f. Beauty is a consumer compounder with a core brand that still has years of growth ahead and a road acquisition that can create another acceleration leg. Celsius is a beverage platform whose next chapter depends less on proving demand and more on scaling what demand has already proven. That is why I like this group. They are not the same business. They are the same pattern. Growth plus misunderstanding, execution plus temporary doubt. And in the market, that is often where some of the best medium to long-term opportunities come from. Now let me say one more thing, because this is the most important part of the whole story. None of this matters if you do not know what kind of investor you are, because great themes and great companies can still produce terrible outcomes for people who are too concentrated, too emotional, too impatient, or too undisciplined to survive the volatility. The source document did not emphasize that as much as I would have, but it was still visible underneath everything. These are growth stocks. That means they can be wonderful. It also means they can be vicious. If the market goes risk off, if rates move the wrong way, if one quarter disappoints, if integration takes longer, if sentiment sours, these names can all go lower before they go much higher. That is not a flaw. That is the admission price. So the right way to think about them is not which one makes me rich next month. The right way is which one still looks meaningfully mispriced relative to what it can become over the next 3 to 10 years if management keeps executing. That is the adult question. And when I ask that question, I understand exactly why the source was so enthusiastic. Because the market does not offer many moments when you can still find real growth, real business traction, and real DE. Rating all living in the same stock at the same time, that is unusual. This is one of those moments. And that is why I would not dismiss this list as a pile of hot names. I would recognize it for what it really is. A watch list of 4 different mismatches, and mismatches, if you can sit through the noise, are where serious money is often made.